Are you looking for some rules that can help you invest smarter and build wealth over time? Investing can be overwhelming, especially when you're just starting out, but with the right guidance, anyone can become a successful investor. It's not about chasing quick wins or jumping on every trend. It's about sticking to proven, time-tested strategies that work. Whether you're just beginning or already have some experience, the right rules can make a world of difference in your investment journey. In this video, we'll break down the top 5 investment rules that everyone should follow to ensure long-term success and financial growth. These rules aren't just for the pros. They are simple, practical steps anyone can implement. Let's dive into these fundamental strategies and get your financial future on track. 1. Never lose money, Warren Buffett's rule. Warren Buffett's investment philosophy is famous for its simplicity. Rule number 1, never lose money. Rule number 2, never forget rule number 1. While this may sound like common sense, the importance of this rule cannot be overstated. In fact, many investors get so caught up in the allure of quick profits that they overlook the fundamental importance of protecting their capital. The reality is, losing money is not only financially painful, but it also severely hampers your ability to build wealth. When you lose money, you're not just losing the original amount you invested. You are also losing the potential for that money to grow over time, compounding and contributing to future returns. It's easy to be drawn to high-risk investments that promise huge returns, especially when markets are booming. But this often leads to major losses when things go wrong. While taking risks is part of investing, it's essential to evaluate these risks thoroughly. Before jumping into an investment, always ask yourself, what is the downside? If the potential for loss outweighs the potential reward, it's usually a sign to steer clear. As an investor, risk management should always be your top priority. The goal is to make sure your investments have solid protection for your capital, while also providing opportunities for growth. Remember, losing money in one investment means that you need even higher returns from subsequent investments just to break even. By focusing on preserving your wealth first, you are laying the groundwork for long-term financial success. Don't fall into the trap of chasing risky gains. Prioritize protecting your money, and your wealth will follow. 2. Think like an owner. When you buy stocks or other assets, think about it as owning a piece of the business, not just a share of paper. Think like an owner, advises investment experts, because when you invest in stocks, you are buying partial ownership in a business. Just like any business owner, your goal is to focus on long-term profitability and growth. This mindset shifts your approach from speculation to investment, helping you make better, more informed decisions. Before making any investment, study the fundamentals of the company you're investing in. This includes understanding its revenue model, its competition, and the industry it operates in. What you want to avoid is simply following the crowd or investing based on rumors. Remember, stocks represent businesses, and just like owning a business, you need to know if the company's management is sound, the business model is viable, and if the company is positioned for future growth. Thinking like an owner means you'll naturally be more patient, allowing your investments time to grow without obsessing over every market fluctuation. This long-term owner mentality will keep you focused on the big picture and less susceptible to short-term market noise. Instead of selling your stocks based on temporary dips, you'll see them as long-term assets that will provide value over time. When you approach investing from this angle, you naturally become more strategic, seeking investments that will add value to your portfolio year after year. Investing with a mindset of ownership, you'll be much more likely to make wise, informed decisions. 3. Stick to your process. Consistency is a hallmark of successful investors. A solid investment process provides clarity and stability, especially when the market becomes volatile. One of the best pieces of advice is to stick to your process, regardless of what's happening in the market. If you've developed an investment strategy that works for you, stick with it, even when the market takes a downturn. It's essential to keep your emotions in check and remember that investing is a long-term game. One of the most effective strategies for building wealth is the buy and hold strategy. With this approach, you invest in assets that you believe will grow over time and hold on to them for an extended period. Regular contributions to your retirement fund or index funds will allow your investments to grow, leveraging compound interest. Even when markets dip, resist the temptation to sell and instead keep buying. Sticking to your process during tough times will help you avoid making emotional decisions based on fear or greed. Another crucial part of this rule is to adapt your process when needed, but always stick to the core principles that guide your financial goals. This means reviewing your investments periodically and adjusting them based on life changes. But don't let temporary volatility derail your plan. Having a process also means developing discipline, ensuring you stay committed even when the results aren't immediate. Over time, discipline will pay off as your portfolio grows, even in the face of market turbulence. 4. Buy when everyone is fearful. It's easy to get caught up in panic when the market drops. But the best opportunities for growth often come when the market is in turmoil. Remember, the stock market is the only marketplace where goods go on sale and no one wants to buy. As Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." During market downturns, there's often a buying opportunity that presents itself. Stocks are typically priced lower during these periods, allowing investors to acquire valuable assets at discounted prices. When the market is down, many people panic and sell, which drives prices even lower. But smart investors see this as a chance to buy quality stocks at a fraction of their value. If you have an automated investment plan like a 401k or robo-advisor, you continue buying when prices are low, helping you acquire more shares at a lower price. This strategy, known as dollar cost averaging, allows you to smooth out the effects of market fluctuations and continue to grow your portfolio over time. Instead of reacting to the panic, buying during fear ensures that you're capitalizing on the market's volatility. The more you stay invested during downturns, the more you stand to benefit when the market eventually recovers. By sticking to your strategy and buying in times of fear, you position yourself for long-term success. 5. Keep your investing discipline. Investing isn't just about how much you invest, but how consistently you invest. One of the most powerful things you can do for your financial future is to maintain discipline with your investing routine. Set a regular amount to invest and stick to it, no matter what. Even during tough times, continue investing. The key here is to automate your contributions and keep investing regularly, without needing to make active decisions each month. The beauty of systems like the 401k is that it takes money directly from your paycheck, ensuring that you invest regularly without needing to think about it. Even if you can only put away a small amount, the fact that you're consistently adding to your investment portfolio over time makes all the difference. As you continue to save, your investments will benefit from compound growth, and your portfolio will gradually grow. One of the easiest ways to stay disciplined is by making small, consistent contributions. It's easy to think that you need to make huge investments to see results, but the truth is that regular, smaller contributions add up over time. Whether it's a few $100s each month or just $50, keeping your discipline ensures that you continue building wealth steadily. Even when the market fluctuates, continue your regular investments. Remember, consistency is key. And there you have it, the top 5 investment rules that will guide you toward building wealth over time. Whether you're new to investing or have been doing it for years, following these simple but effective rules will help you make smarter decisions and grow your wealth. Keep in mind that investing is a long-term game, so patience, discipline, and consistency are your best friends along the way. If you found this video helpful, like, share, and subscribe for more tips on smart investing and wealth-building strategies. Let me know in the comments, which investment rule do you think will have the biggest impact on your financial future? Thanks for watching, and I'll see you in the next video.